Hey, well, welcome back. So it's another one of our little videos here, our lectures. The topic today is Ipsas number 33, the newly issued this year's standard on first-time adoption of the accruals basis. And we are going to be looking at a practical guide to interpretation of this standard. The standard itself, when I clicked open, is some 140 pages long, including God knows what that everybody feels they need to show these days. So we can only cover the key issues and the key areas of that standard. Let me move that down a bit, so I can make myself look a bit thinner. We're only going to be looking at the key issues for implementation that are included in the standard. We can't hope, unless we did like a full day's course, which I don't have time to do, or training on the standard itself. So please notice if you are working in implementation, kick off your shoes, get yourself a cup of tea and a sandwich and have a listen. But you are actually going to have to go and read the whole damn thing. Excuse me. Right, my name, as you can see from the slide, is Mark Pritchard. I have been involved in Ipsas implementations in almost 20 countries, I think now, all around the world. And if you're watching this on YouTube, go to our website, which is mfielding.com, or even mefielding.com, so I can get the name of my own website right. And you'll see that there's a whole load of these things. We do implementation videos on various issues. Right, it's not the most thrilling of topics, first-time adoption, so I'll do my best to keep you entertained. And thank you for watching us. Anyway, please click like. Nice when people do that. Thank you. Okay, so here we've got slide number 2, objectives. The objectives come from paragraph 1. You'll see as we go through this, all the way through, we've selected certain paragraphs, and so therefore by definition others are omitted. You do need to read the whole thing. I think slide number 2 with the objectives is probably the most important slide of the whole 18 slides that we're going to go through in this presentation. I was working not for, but with and alongside the Ipsas board back in about 2008. And at that time I asked the question, are you going to issue a slide on first-time adoption? Are you going to issue a standard rather on first-time adoption? And they said no, because it was just simply too difficult to do. They've obviously changed their mind since then, and we've now got standard number 33, the evidence is in front of you. I think that the problem is that what do you actually do with an accounting standard? You have a government, and the government has an accounting system. It needs to get from that accounting system to Ipsas. Now, we've said this before, that's a change management process where you're going from situation A, which is where we are now, to situation B, which is where we have this Ipsas compliant accounting system. Everybody knows what situation B should be, what situation B should be, what should be there. What people don't tend to know is what they actually currently have, because governments just spring stuff up over time. And remembering that most of the countries that are looking at this are developing countries, so it's what they were doing 20 years ago. Alright, bearing that in mind, it's so hard to write an accounting standard that shows you to get from God only knows what currently exists to Ipsas. The second thing is it really an accounting standard? When you're doing implementations in real life, most of your time is spent dealing with IT, and then as the IT progresses, you're dealing with training so that people understand what they have to put into the computer and then understanding what comes out. There's not actually that much accounting in there for individuals. They just see the results. Right, that's a kind of a general chat on the problems of standard setting in the background of Ipsas implementation. So what have they done? I think let's just look at the third one first, where the benefits are expected to exceed the costs. I think that's in every standard, so we can move quickly over that. Right, the purpose of the standard, therefore, is that we should, being the government, should provide transparent reporting about a first-time adopter's transition to accrual basis. I have to say, with all of these things, the famous Jewish saying, never show people how you make two things, those two things being laws and sausages. An organisation will be transparent. It can't write. Politically, it won't be able to write something in its accounts that says, we just don't know what assets we own. But for most countries in the world, that will be true. And then once we've decided what we own and decided whether we own them or not, how much the bloody things are worth is another question. So the objective is, as so far as we can, politically and practically, to provide a transparent view of the implementation process. Again, countries I've seen, worked in or seen, Kazakhstan, for example, very, very quick, at least in the theoretical side of it, and filled a website with what we were doing out there. Places like Latvia were significantly less successful. Right, that provides a suitable starting point for accounting in accordance with the accruals basis. Again, my usual phrase would be, well, if I wanted to undertake a project on accrual accounting, I wouldn't start from here. Provides a suitable point. I think I'm assuming, therefore, that suitable point means a balance sheet of opening balances, which we are relatively comfortable with. Right, what's the point of the slide in terms of you as an implementer? What we're saying, therefore, is that the object of this standard is that it is telling us that we have to be transparent. So we have to tell people what we're doing, and we have to tell people what we have and what we don't have. That will not be an easy process in real life for political reasons. Secondly, it provides us with a starting point. Right, a starting point? What is a starting point? Well, at least the Ipsas board are trying to give us some information on what a starting point ought to be. In a perfect world, in a classroom environment, we're going to get a nice balance sheet, which is completely Ipsas compliant, and then we can make our changes over the year. The reality is that balance sheet will be a work in progress for a number of years as we strive to move towards Ipsas compliance. Let's just say when we talk about Ipsas compliance as well, there is only one country in the world, New Zealand, which is normally considered to be 100% Ipsas compliant. All other countries have varying degrees of variation from Ipsas, and those variations often have very practical reasons. In Great Britain, for example, like Scotland, Great Britain, for example, does not have Ipsas. It uses IFRS. So, right, those are the objectives. Let's just summarise that. Therefore, you can see on the slide what's written there. The first 2 points. This is what you are trying to do during your implementation process, to develop a starting point to opening balances and to be transparent to users of accounts. Everything else is an attempt to achieve those two things. So always you should have that in mind. Okay, again, you're beginning to see now how loose, how fluid, and how difficult this is actually to achieve. And congratulations, I guess, to the Ipsas board that they've at least had a damn good stab at it. Okay, so slide number 3, which is the application of the standard. This actually is a long piece here, and you can turn me off and read this. But it's actually much simpler than it looks. But it's a bit of a strange one, I guess. What this slide is actually saying is that the first time adoption standard doesn't apply to any country which produces accounts which are already Ipsas compliant. Now that's actually really important in real life, because all countries, as far as I know, all countries use what we call national standards. So in other words, what they do is they take a set of accounting standards and they adopt them as their national accounting standards. Now the reason that governments do that is because it means that if they want to change certain things, they can. So for example, some countries don't want to disclose in their accounts their spending on the military, as a good example. Secondly, the other thing is that Ipsas get updated every 3 months or so. For many countries, if these things are actually law, that means the rest of things have to go through Parliament, and Parliament feels that it has more important things to do than update accounting standards every 3 months. So what they do is they adopt national standards, and then they have an updating process where every 2 years, for example, which Kazakhstan were like, which is where they will group all of the updates in one go every 2 years, and the thing just goes through quickly. So the application, therefore, is only applies to countries which are specifically going from non-compliant accounting systems to compliant accounting systems. Where you're going to get grey areas is that countries, again, will not introduce usually accrual accounting in a one-er. In other words, they'll start by introducing debtors and creditors, your receivables and payables, into their accounts. Then they will usually start by putting other sort of things like financial instruments in, which despite students' hatred of the subject, it's actually quite simple. Then they will usually start beefing up their assets, and then at some point they'll bring their assets in. So we get this idea of a gradual change rather than the change that the Ipsas board envisages, where on Friday we had some old cash accounts, and on Monday we have these super pooper new accrual accounts. So does it apply or does it not? And what if we're not going all the way? You're going to have to make a judgment call on that. But in general, the standard does not apply where we already have accrual accounts which are as good as or close to Ipsas. So a long paragraph there that says something really very obvious and simple. Okay, slide number 4 is just a little bit more to add on to slide number 3, which I guess is kind of obvious really, isn't it? They come next to each other. But all it's saying is that Ipsas does not apply to changes in accounting policies. That's covered in standard number 3. So not much more to say about that. And then it also, but please do remember that individual accounting departments in governments have tried to say this is something completely new. Again, your issue in real life will be the grey area where you have certain parts of your accounts are Ipsas and certain parts aren't. The second one down there is the certain specific transitional requirements. I want to just leave the transitional requirements because we'll come on to those. There are certain actions are permitted as transitional. In particular, you'll see a thing that we're coming across called the 3-year holiday, as it's referred to in real life. So there is a period of time that allows you to transition from your old system to the new system. Right, what Ipsas actually allows is transitional periods of time, transitional relief, we would call it, tax days, is limited to 3 years, and it's limited to certain scenarios as well. So we'll cover that, but it's something that you will need to read up on. Right, the whole point of slide number 4, therefore, is that it doesn't apply to a change in accounting policies. It means literally first-time adoption of the whole system. And there are specific transition requirements, and we'll come on to specific transition requirements a little bit later. Okay, slide number 5, transitional statements. So we're moving into transitional statements. As I said already, there are certain standards which allow you extended periods of time for conversion. So everyone's favourite is fixed assets, PP&E, property, plant and equipment, Ipsas number 17. So you have a 3-year period. Now, what will happen is that let's assume you have a vice minister who's running your project, which is Ipsas implementation. He will have told everyone that Ipsas will be implemented by a certain date. Then what will happen is that he will realise that he has absolutely no chance whatsoever of achieving that, so he will take the transition. So he will take the transitional right to say, well, we're not really actually ready with our fixed assets. And there's others as well, like leases, biological assets, agriculture and so on. So at that point, therefore, he's playing 2 cards. He's got one card that says we're Ipsas compliant, and his second card that says actually we're not, we've taken a transition. So let's have a little look at what paragraph number 13 says. It says that an entity's transitional financial statements are the financial statements blah blah blah. If a first-time adopter adopts the exemptions, it will not be able to make an explicit and unreserved statement of compliance. Right, you need to highlight that, and I'm sure that this standard is going to be bright yellow, but you need to make sure that the guy who's the government counterpart in your project knows that up front, because he is going to want to make that statement as soon as he possibly can to show what a great project manager he is, and you just aren't going to be able to let him. The standard does not permit you to do that. And again, if he's adopting these things as standard number 33 of the government of far away, he is not going to be able to make this. He's not going to be able to issue a set of accounts so they're compliant and his own national standards are compliant with Ipsas, because he'll take that out, and it's exactly what he'll do. We'll just delete that sentence and then we've done it, and everyone's happy. Ipsas doesn't allow you to do that. If you have transitional accounts, which means that you are not valuing your assets at fair value, for example, with standard 17, then you can't claim that you are completely compliant with Ipsas until you've achieved the requirements of the standard post-transition. It doesn't sound like much. That's going to be a day of conversations of your time with the counterparts because they won't be happy about that. Okay, mercifully short slide, my teeth in place, mercifully short slide, which is number 6. The whole point of this is that you need to prepare an opening balance sheet. Now that is going to be another big issue for you in real life. You have to prepare the opening balance sheet because you have to have opening positions. Let's assume that your country far, far away is assuming Ipsas from the 1st of January, adopting Ipsas from the 1st of January 2016, your first set of financial statements therefore will be the 31st of December 2016. Now your counterparts will automatically go, brilliant, now it's April 2015, so we've got 20 months. No worries. But you don't have 20 months. You don't have 20 months because you must have that opening position. You can't show the movement in provisions if you don't know what the opening position is. You've just got the closing position. So therefore, we have to have this idea of an opening balance sheet. Right, that is going to be, for your counterparts, an absolute nightmare. Because if they are using a cash basis, they will prepare their accounts at the 31st of December 2015 under the old basis, which was the cash basis. And then they're looking at 31st December 2016 under our new super pooper shiny Ipsas accruals basis. But when you tell them they have to prepare a balance sheet under Ipsas at 31st December 2015, that means it's an extra amount of work. In excess of double. Their job has just doubled in size. And they have a busy period anyway. So you can imagine how popular you're going to be. So you need to get that up front and you need to plan it. And you're planning it in terms of communication skills and HR skills. The other thing as well is that it means that you have to have your computer system up running and producing information by the 31st of December 2015, because it will have to show you what the opening balance is, or it will have to have the capacity to make retrospective calculations. If you are doing contracts, for example, so let's assume like when I was at UN Women, we had all of our contracts. It means that all of your contracts have to be in, and then the system itself will calculate for you what your opening debtors are, your opening receivables at the 1st of January 2016. So plan for that, make sure everyone knows it's coming, and make sure that your workers in your finance departments and all your other departments are ready to collect the information. They won't be happy because they've now got to do 2 things during what is their busiest period of the year. Okay, so moving on with our list of little paragraphs within this standard that you need to be aware of and that can potentially cause you problems, let's just have a look at paragraph 19. Counting policies. So a first-time adopter shall apply the versions of accrual-based Ipsas effective at the date of adoption of Ipsas. Right, that is going to give you a problem as well. I have to say that I have never ever met a country which wanted to adopt old versions of standards. Every country I've ever worked in has always been happy with the Ipsas. The problem is that Ipsas have a stated aim of following IFRS, and they are something of the order of 2 to 3 years behind IFRS. Therefore, what will happen is that your government will say, well, what are we adopting this for if we know it's going to change in the future? Why don't we just adopt the IFRSs that exist at the moment, and then we don't have to make any changes for the next 3 years. And as an implementer, it's actually very, very difficult to argue with that logic. It gets even more complicated because when you prepare your all of government accounts, you have to start including government business enterprises. Now, government business enterprises don't tend to be that big or that material, that prevalent in Western Europe. But in some of the countries that we work in, countries in the former Soviet Union, the government is 90% of the economy. So these, Ipsas tells us, these government business enterprises, Ipsas tells us themselves, should be accounted for under IFRS. So let's take an example where you've got financial instruments. Financial instruments, certainly 6 months, a year ago, had this old system where we still had, the hedging requirements and the tainting problems with our standards, and yet IFRS themselves had moved on hugely, huge changes. So now what's happening is you're trying to consolidate the centre bank, which accounts for all of its derivatives and all of its financial instruments under IFRS, because it's effectively a commercial organisation, and you're trying to consolidate that with, let's say, municipalities who've issued Eurobonds or whatever, and we're accounting for those under the old Ipsas rules. So you've got different problems there. The guy in charge of the project from the government is saying, well, we're going to have to change so that the municipality matches the centre bank in 2 years' time. And secondly, how do we consolidate when there are different accounting policies? We have to restate the centre bank. Well, much easier to restate the municipality. So do you see where this is going? Governments are going to go, financial instruments has been the biggest one. The government, everywhere we go, a government will adopt a national accounting standard, and the national accounting standard will match the latest IFRS on financial instruments, and they will just ignore the Ipsas. Standard number 33 tells us that you're not allowed to do that. No, you're not allowed to, but you shouldn't do that. A first-time adopter shall apply the versions of accrual basis effective at the date of adoption of Ipsas. How do you get around it in real life? For me personally, I would say go with the old system, go with the IFRS system, go with the old system. Go with the idea that we use the IFRS. For the very simple reason that often what happens with these things is when they're national standards, you'll find the process of writing a standard, getting it approved by the government lexicologists. Did I just invent a word there? The people who look at the language of government laws and then want to rewrite the stuff, and then getting it through the state parliament means you've probably got a 2-year time frame anyway. So we are adopting Ipsas, but we have no actual accounting standards to back those up because Parliament hasn't adopted them yet. So we're preparing accounts under standards which are not the law. Very common. By the time those standards go through Parliament, Ipsas board will have adopted the IFRS on financial instruments, which is what happened in several countries that we were providing consulting advice to. So my advice to you would be, bearing in mind that these are national standards, is to go with the idea that the national standard matches the IFRS. Can you note you cannot then claim that you are 100% Ipsas compliant, because you're not. Your standard's different. And that will be another conversation when your Minister of Finance wants to stand up at the EU and wants to stand up at the Asia Pacific Finance Ministers Conference and say we're Ipsas compliant, because he won't be able to do it. Politics. Horse trade it. Okay, so for those of you who've been through an implementation, this will be a fairly obvious topic. For those of you who haven't but have got it coming, I would strongly suggest that you go to our website and watch some of the videos on things like procurement or PP&E, because it will explain to you what this means. Can you see that if you're going to adopt Ipsas from the 1st of January 2016, you will be preparing a set of accounts at the 31st of December 2015 under the old rules. So let's assume you have the stereotype classroom example where it's produced on a cash basis. What will happen at that stage, therefore, is you prepare your accounts under your old rules. They are true and fair under those rules, and they'll show the cash you spent and the cash that's coming in. If it's all based on a cash basis, what is going to happen, therefore, is that all of the things that you had in there, which were fixed assets, for example, will be shown at their purchase price. So over the years, they will all be shown at their purchase price. Now what's going to happen is that you are going to have to show your assets as asset at cost minus accumulated depreciation, as if we'd owned it, and then that will have a net book value balance. So you have a car, cost you 20,000 bucks, it's 2 years old of its 5-year life, so it has a balance of 8,000, whatever. Right, when you make that change, the question is how do you get those things into your accounts? Well, you're going to have to debit fixed asset at cost. So we said we had a car that cost 20,000 bucks, so we debit 20,000. We said that the thing has a life of, let's say, 5 years, no scrap value, and we're now 2 years in. So therefore, if we're 2 years in, the accumulated depreciation will be 8,000. Yeah, it's 2 years from 5 is 40%. and the thing has a net book value therefore of 12. So we debit fixed assets 20,000, we credit accumulated depreciation 8,000, and bingo, it's in our books, net book value of 12,000. But the problem is that an accounting system doesn't work like that. You just debited 20, you credited 8, so where does the 12 go? We have a missing number. Right, that missing number has to go somewhere. Where it will go will be what we call the Ipsas reserve. So you set up an Ipsas reserve account, and it's just a dump. So what will happen is it will collect all of these debits and credits that make all of these journal entries balance. So we will credit the Ipsas reserve $12,000. Straightforward. Right, there's a couple of things to say about that. The first thing is that has to be, that being that particular car, has to be in your opening balance. So in terms of timings, what's actually going to happen in terms of your IT system and your accounting records is that you're going to have a period of time which falls between the 31st of December. My hands go the wrong way when I do that. There we go. I'm actually moving them right now. There is a period of time that falls between the 31st of December 2015, here we go, the 1st of January 2016. So in your IT system, assuming that you have an Oracle system or you have a SAP system, you can put various periods of time in. When I was at the UN, we used to call it period 100, and it simply reflected this period of time. If you have a bit more of an old-fashioned system, then you're going to have to get your IT guys to give you the opportunity to do this. Because these things must not be included in your closing balance at the 31st of December 2015, but they must be included in your opening balances on 1st of January 2016. Right, that's the first thing. And that's a purely practical thing, and in real life it's IT. So you get your accountants, they put all of their debits and credits in, and you have your dump. The biggest thing is you're going to have this huge credit for fixed assets. You'll have a huge asset, and that huge asset will be usually for pensions. So if you have an occupational pension scheme with a defined benefit scheme, you'll find usually most governments have a huge liability for that. So you credit the liability. Where does the debit go? The debit goes to this Ipsas account. Right, so thing number one is that you have to set up this period of time, period 100. That's the first thing. And the standard tells you that you need this. So the standard is very clear on this, paragraph 21, blah, 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 you get this thing. Right, what the standard does not tell you is it does not tell you what you do with it subsequently. Okay? So it does not tell you what happens. Because if you think about it, you have this big liability for pensions, so you debit the thing. You have all of these assets which exist on the 1st of January 2016, so you credit your Ipsas account. If you just leave it there, so if you just leave the thing there, in 10 years' time, you're going to have a great big balance, probably a debit balance for most countries that have pensions. You're going to have this big balance on this account that bears no relation to nothing. No relation to anything, I think I should be saying. So the thing is what are you going to do with it? And I can't give you an answer to that. My preferred approach, if I got to choose, would be to say, okay, this Ipsas account has a life of 10 years and will depreciate it over 10 years. So assuming it's a big debit balance, we'll credit this, because it's going to mean your capital, yeah? We'll credit the Ipsas reserve every year, and we'll debit retained surplus. And then in 10 years' time, it will be gone. Because we can conclude that in 10 years' time, all of those assets will have expired their useful life, belong to their buildings, and pensions will have moved on and will be fully reflected, blah, blah, blah. Right, but that's just my personal opinion. I can't make you do that, and I have to say, as I remember what the UN did with it, is they just left it, so it's going to sit there. So in 10 years' time, there will be a big debit balance in UNDP, for example, and that will be there. And quite how at that point they're going to explain what it is, I have no idea. If they have retained surpluses over the next 10 years, then they can credit it and debit the surplus, and the thing will be gone. But who knows? I guess you just leave it there, and then the people that make that decision move on to new jobs, and it becomes someone else's problem. But I hope you're clear on that. You need to set this thing up. That is an absolute given, and it must exist. My question then would be, this isn't in the standard, and I can't give you any practical advice. When you've got this balance on the reserve, what do you do with it going forward? Um, my preferred approach would be to get rid of it, to amortize the thing over a number of years, and just take it through your reserve account. So you would credit your Ipsas reserve, assuming it's a debit, and you'll debit surplus, the retained surplus, and just do it through, and then the thing's gone in 10 years' time. There is no answer, and the standard provides you with no advice whatsoever on that factor. Oi. Right, slide number 9, halfway there. Slide number 9 is an important one again because of the politics involved. It tells us quite clearly that a first-time adopter may need to make estimates in accordance with Ipsas, and that those estimates should reflect the conditions and situation in place at the time when we are adopting Ipsas. So if we're adopting from the 1st of January 2016, what are the conditions in place now leading up to that adoption, and what will be in place on the 1st of January? You will find that this is important because your government counterparts will have certain political aims. Usually what they want to do is they want to maximize the value of the assets, minimize all of their expenses, and minimize their own personal responsibility, which is a perfectly normal human condition. Therefore, they will say, oh, but when we bought this thing, we were going to intend that, yeah, it will be a library for a couple of years, and then we'd sell it as an office block. So you should value it as an full value office block. And you're saying, but yes, but it's actually a library. It's actually a library. So the value of it as a building, as a library that generates virtually no revenue is virtually zero. Right? Do you just before we move on with that, let's just make sure you understand the scenario. We have a building in the middle of a large town, which is a library. As a library, the valuation of the building is very, very low because it generates nothing. I mean, people paying fines and whatever, using the computers or whatever, maybe there's a cafe and something like that. However, if you were to close the library and sell it as an office building, then the value of the thing as an office building would go through the roof. And Ipsas tells us we have to have these things shown at fair value. So what is your valuation policy? Do we show it at $1 million as a library or $20 million as an office building? If it is a library at the date of adoption of Ipsas, then it should be valued as a library. So it should have the lower valuation. That is, as an academic exercise or as an academic point, really fairly simple. As a political point, good luck. Because people will cherry pick amongst the buildings and they will say, okay, well that building should be valued as this because that's what it was, blah, blah, blah. Or you get the other situation where it's being used as an office building and people will say, oh, but originally it was meant to be used as a library. We want the value to be 1/20th of the value that you want. And they want to do that because they may have an option to buy it and they can buy it at valuation or whatever. So therefore, the valuation or the estimates that we're making, such as valuations, should be made taking into account the situation that actually exists at the date of adoption. If you're doing this 6 months before adoption and the situation is going to change, then you take the date of adoption as the valid date. Right, again, intellectual point, very straightforward. Political point, absolute nightmare. I put this slide up. Something must have been going through my mind when I wrote it, when I cut and pasted the section in, but I really can't remember what it was now. I think, therefore, that this, again, as an intellectual point, is fairly straightforward. The only thing that leaps off the page at me is, for example, okay, I'll give you an example. Right, first of all, have a look at it. All it says is that your account should faithfully represent the financial position, performance, and cash flows, which I hope is completely obvious. There's nothing to learn there. The only time we've ever had any problems with this is when people have tried to make things too complicated. When, for example, you have non-exchange revenue. So non-exchange revenue is that situation where people give you money, but they don't necessarily get the same value in return. Obvious example for government would be taxation. So where we saw an example of this was with the United Nations, where they were getting donations. Now, if the government of Scotland gives money to the United Nations and the United Nations runs a project in Burkina Faso, for example, the argument would be is that is a non-exchange transaction because the government of Scotland does not get the benefit of the project. The benefit of the project goes to the government of Burkina Faso. So that would be a non-exchange transaction. So the question is, how do we treat in the books of the UN that donation? If it's a 5-year project and all the money's given up front, is the money all shown as revenue now? Is it shown as revenue? Do we spread it over the life of the project evenly? Do we look for key deliverables in the project and try to split the thing across the project? Blah, 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 blah. Long discussions. One of the biggest things that came out was that there is no matching concept in standard number 23. Standard number 23 is non-exchange revenue. And can you see there can never be the matching concept? Because you're not matching, if you go to buy a loaf of bread, when you hand over £1, you get your bread, there is a match there, isn't there? We give £1, we get a loaf of bread. So we match the delivery of the bread with the giving of the £1. If you're giving money and you don't get anything back, there's nothing to match. So you can't match it. But the only issue we had with this, therefore, was, well, then how do we recognise that revenue? The easiest way to recognise the revenue is simply to say, okay, well, once it's paid, it's gone, because governments virtually never get money back from the UN. They don't ask for it. I think the level of money that goes back is like considerably less than 1% that comes in. And the biggest issue we had politically with this is that people felt it's Ipsas, it's accruals basis, so you have to change. If people are giving us money and we recognise it as income at that point, that's the cash basis, but we're not on the cash basis. And so we got this idea that there was no problem whatsoever, really, with just keeping going for certain transactions with the cash basis. So I think, therefore, bear this in mind, that when you are looking at first-time adoption, we still get this idea of true and fair that comes to do with corporate accounts. And if true and fair means, for example, staying on the cash basis, or changing things so that one ministry no longer is reflected as receiving revenue, it actually goes to another ministry now, then you need to be ready for that and ready to have those discussions. I hope that didn't confuse you more. It's really, I don't think, a very difficult section. Your accounts have to present the financial position, performance and cash flows in an honest, fair and transparent fashion. And that's all fairly obvious until you start discussing what that means. We've talked about this idea of transitional accounts. There are a number of standards, and we're coming up now to looking at what those standards exactly are. Allow some transitional period. So again, we've already mentioned this, but fixed assets, leases, and so on, they give you a 3-year period. So say we're going to start to adopt Ipsas from 1st of January 2016. But we won't actually be showing all of the assets that the government owns and operates for 3 years, which is 16, 17, 18, until the 31st of December 2018, or even the 1st of January 2019, because we simply need extra time. We're going to come to that, and we're going to talk about that again. The only thing which is really important on here, which will happen to you or may happen to you dealing with the government, is it says a first-time adopter. If you look at the end of the first paragraph, and shut me up and read this yourselves anyway. Right, let's just have a look at the first paragraph. A first-time adopter shall not apply these exemptions by analogy to other items. What does that mean? Right, this is something that you can come up against in real life. We're going to take 3 years for our fixed assets, so therefore we'll take 3 years for our procurement as well. And you're like, well, why would you do that? Well, because we have to buy fixed assets to get them into our account. So procurement must be affected as well. No. Right, that's what you're not allowed to do. You have to limit it to that property, plant and equipment that you're purchasing. You can't just keep spreading this thing and use the exemptions, transitional rules for something and then spread it right the way across. Yeah. So therefore you need to keep it nice and tight and be careful, because once again, anything that looks difficult, let's offload it for 3 years, and hopefully in 3 years I'll have a new job and it becomes someone else's problem. So please keep that nice and tight, and do remember that, because you may come under pressure to do these things. Let's just have a look at the second paragraph as well then. It says, therefore, to the extent that a first-time adopter applies the exemptions in paragraph 36 is not required to apply any associated presentation and disclosure requirements. That is absolutely huge as well. So you're not, if you are exempting yourself from adopting Ipsas 17 on fixed assets, you are not then required to go through all the disclosure requirements about accumulated depreciation, key valuation techniques, etc., etc. But obviously, once you have adopted Standard 17 and you're through the transition, then you will have to disclose those things. Right, let's have a look at the next slide then and see if we're ready to move on or not yet to the actual transitional provisions themselves. Okay, so paragraph 36 sets out exactly the standards which we are allowed to take this transitional relief period. And I've cut that from the standards, so it is actually called traditional relief. Right, this is very, very important, and most governments and indeed many organisations like UNDP, I think, take these things. The Ipsas board has taken on board this idea that it's hugely difficult for a government to record and value all of its assets. So therefore it gives you this 3-year period, and the 3-year period extends the amount of time that they have therefore to comply with the standard. There's two things to say about that. The first thing is that it's 3 years now. It used to be 5 years. I think the Ipsas board felt that if it becomes 5 years, then governments just put it off and put it off and put it off. Whatever happens, they'll do it at the last minute anyway. Personally, I felt that even 5 years was a push. I was very surprised that they cut this down. You know, when you're dealing with countries like Russia, which we worked in, I mean, the assets are enormous. Then if you look at inventories as well, they're therefore basically required to survey the entire country, which covers whatever 20% of the landmass of the world, and then work out what's in there and put a value on it and stick it in their accounts as well. The cost, I think we estimated, would be something like $100 million. And then you have to say, well, what is the benefit that we get from that compared to the cost? So the 3-year period, almost everybody takes it. They buy themselves a lot of time, even in certain circumstances, because it gives them time then to get the auditors on board, so the auditors understand what they're doing. Personally, I liked 5 years better than 3 years. Right, that's the first thing. So we have these transitional periods. Right, now there's something that's even worse about this, is that what the Ipsas board does not tell you is what you do in the intervening period. So in other words, let's assume that we are going to adopt Ipsas from the 1st of January 2016, but we are going to take the transitional relief for 3 years on fixed assets. So 2016, 2017, 2018. Right, let's assume we're just talking about fixed assets. What do you do during that period? If you had an old system, are you going to put those fixed assets into your balance sheet using the old values? That's one option. Secondly, are you just going to show a blank piece of paper? So we're going to have nothing for fixed assets on the balance sheet. That would be another option. The third option is, do we have nothing on the balance sheet, but do we have a disclosure note going, this is what we've got, but it's under the old system. What happens if we're changing? We have a whole army of little ant workers out there valuing all of our oil processing plants, our libraries and so on, our monuments to Stalin and Lenin. Do we start introducing them into the accounts on a one-by-one basis as their values, or do we keep them separate and then do it as a one-er at the end? Or do we just stick a number? We think it's, who knows? That is your problem in real life. If you're going to take the 3 years, okay, take the 3 years. It makes sense. What the Ipsas board does not tell you is what you're supposed to do in the intervening period. Right, in terms of sticking the numbers in the balance sheet, it seems to me that we shouldn't be messing things up. So probably best to show nothing. Or if you're really lucky, like if you work in a country which is an old Soviet republic, you had the numbers previously, you just assume they're equal to the values, and then you transfer them across and get the auditors to sign it. It's true and fair. You can do that. Right. Who knows? And what are you going to put in your disclosure notes? It tells us we are supposed to have transparency during the transitional period. So that kind of makes sense. We have some transparency during the period, but you've got some assets that are valued, some which are under their old values, and some which you haven't even found yet because it's oil wells. Russia's just found enormous reserves of oil underneath the Arctic Circle. Right, I don't know what you do. Usually, what I would recommend is do what the standard says, and the standard says be transparent. We have to date got this, which is the old system. These assets are not Ipsas compliant, they've not been revalued. This proportion of our assets has been identified and revalued, and we still have significant more work to do on asset identification. In what considerable way that assists users of accounts? So if you are an international lender, the World Bank, you've loaned money to a country and you see that in a set of accounts, doesn't look good, does it? I actually don't know what you do, and I think it's very poor that the standard doesn't assess this 3-year period or give us some guidance. The only thing I can tell you, because I had a very limited amount of input into this, is that the World Bank is a big promoter of Ipsas, it's a big supporter of Ipsas, and so therefore the people that you're dealing with who loaned you the money, if you are a government, should understand what the hell it is that you're doing, and so therefore they should be relatively sympathetic. And they are a huge promoter of Ipsas as well. But really, it's pretty tough back there. Okay. Okay, then just moved into a different office and I've got a client just come in. Let's just finish this off. Right, paragraph 39 talks more about this transitional period. So we talked about the problems of the transitional period and about how the standards don't actually tell you what you're supposed to do during that period. Now all this does is it goes on therefore and says that you have a period of 3 years to change your accounting policies. What it doesn't really cover is this idea where we've got systematic changes. So in other words, where we start by saying, okay, then we're going to do assets, but we won't do leases. How does that affect us? So we can comply with number 17, but not with number 13. So we can comply with property, plant, and equipment. We can not comply with leases. How does that affect our balance sheet? And it also, but the one thing it does do is it gives us this idea that we can change at any point, so you don't have to take the full 3 years. If you are working on an implementation program and you're looking at this, you have to put into your planning some very serious thought what you're going to do here, what your IT system is going to be able to report, and then when it reports, how you're going to explain what you're actually reporting. If you're gradually piecemeal putting stuff in, is there really any meaningful information, and how do users of accounts actually take that? It's very, very difficult in real life to do this. As I said, in general, in my experience, I've been quite lucky. In countries like Kazakhstan and Kyrgyzstan, they have actually kept fixed asset records. So therefore, they have a centralized system. And bizarrely enough, they had historically a cash-based system, but they still kept assets and they still depreciated the damn things as well. So that sounds like a very odd thing to do, but it made our life much easier because you just took that and shifted it across. So what do you show? How do you explain what you're showing, and how do you make the information meaningful? And the standard doesn't really give any advice, and outside of the standard there isn't any advice either. So you just have to do the best that you can and say, this is what we've got. If there are concerns that there are lenders such as the World Bank, the IMF, these organisations know what Ipsas is, or know what Ipsas are, and so therefore you should find that the discussions aren't too difficult with them. You would hope. It is not something easy to decide in real life. Once you've made your decision, then you have to go on with it as well. You have to remember with this stuff as well that the Ipsas talks about fair value, and that means valuing all of your assets. You've got big countries, Brazil, Russia. Just the cost and the time and the volume of people involved is phenomenal. Okay, this is a new concept that's come in for first-time adoption. If used properly, it will be a huge step forward, and it's a great thing that the Ipsas board have accepted this. You have to be very, very careful in real life, though, that it's not just a get-out-of-jail-free card. What the standard says here in number 67 is that when you're valuing items, you can use what's called the deemed cost. Right, the deemed cost, therefore, is some form of fair valuation. So therefore, and you get this in real life. Let's assume that you have a building and the building was built in the 1890s, but it's still now an office for the Ministry of Transport or something. The thing is that when the damn thing was built, it probably had a cost of $1,000. Now it's worth 20 million. So you get the thing, you can get the thing valued. Now that's easy enough for things like an office building that's in the middle of the town. What do you do with things like military air bases? Military air bases hugely difficult to value because they tend to be in places where there aren't any people. So you can't even value it as a commercial airport. If you value it as a piece of land and individual assets, they're probably worth nothing. Certainly in most developing countries I've been working in as well, the problem with military air bases is that you couldn't use the land anyway because it's totally soaked through with aircraft fuel. So therefore we have this concept of the deemed cost. And what the standard allows us to do for these items here, where we don't know the cost, so for example, you have a country which has been at war. So what's the cost of a building in Donetsk in Ukraine? We don't know because the records have been destroyed. And what's the value of the building as well, with a wall missing. So we get this idea of deemed cost, where the records are meaningless, where the records have been destroyed, or where there are things which are just so bloody difficult to, or which are just so damn difficult to value, or they have no alternative use. And military air bases was something that we did in one of the countries where they were trying to do these things, and they said, well, how do we do it? So you can try and value a military air base, therefore on the basis of breakup costs, but what are the buildings worth if nobody wants to use them? Nothing will ever grow on the land. The damn thing's hidden away in the mountains somewhere to be difficult to find and follow by potential enemies. So you put a thing called a deemed cost on it. I have to say that as far as the Ipsas board is concerned, it is a very, very good idea. It means that in situations where governments simply just don't have records, or they're in, they've had multiple changes of currency and we have no idea what the damn currency should be now, it gives us the opportunity to put a proper value on things. The problem with it will come, and I have never seen this in practice because this is brand new. So it came in the exposure draft, exposure draft 53, when it came out 18 months or so ago. But I've never seen this in real life. We're going to have to make sure, or practitioners will have to make sure, that governments aren't just going to go the values. There you go, finished. And there's going to be a huge pressure on governments to do that. The Ministry of Finance just goes, there you go, there's your value. It's going to save millions. As I said, if you think a normal country, even a country of 20 million people that has no state valuation department, then how they're going to have to open a state valuation department, they're going to have to hire valuers, they're going to have to train them, they're going to the cost will run into millions of dollars before one person even takes his clipboard out. So therefore this is going to be on one hand a very, very powerful and useful tool, on the other hand something where we are literally going to have to stop people from just making stuff up because that's cheap. Again, I look forward to hearing from anyone who's actually done this. Added pressures in some countries as well are that they allow government employees to buy assets at their written down value. So there is a great temptation for you to put very low value on this, significantly below market value, and then employees can buy it and sell it on and make a nice little profit. So this is going to be something which is going to have to be watched carefully. And I am going to watch very carefully until I hear use of somebody actually doing this in practice. In fact, I'll make a mental note to go away and write something now so that I remember to look on LinkedIn to see if anyone's doing this in real life. Maybe we can get some guidance from someone. Slide number 77, slide number 15, paragraph 77. This is pretty straightforward actually. And it's pretty clear. A first-time adopter is encouraged but not required to present comparative information. I think there's a straightforward message there, isn't there? The board wants comparatives so you can see what's changed year from year. The problem you've got is that if you've gone from cash basis to accruals basis, the numbers by definition are not comparable because you're not comparing apples with apples. So therefore, you have a choice there. Please note, this is really important, and it's really good news for implementation programs and implementation teams, is that you are not therefore required, to go back and restate previous years under Ipsas. And that has been a fear in the past. It's never been a requirement, but it has been a fear in the past. So I think that's quite clear there, and it doesn't really represent any great implementation issues. I think we just highlight it here because it's an important piece of information. And good news. So just have a look at the slide here, which is paragraph 78. Again, it's very, very simple. Very, very simple. It's very, very straightforward. So it says whether you elect not to present comparative information, blah, 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 the adoption, its first Ipsas financial statements. Right, what it's telling you therefore is, remember in the time frame that we've constantly referred to, this idea of adopting Ipsas on the 1st of January 2016, so your first actual financial statements will be prepared on the 31st of December 2016. So they're prepared 365 days, 366 days for 1 year after you've actually adopted Ipsas. Right, on that basis, all that this is setting out for you is it's setting out the minimum amount which should go into that set of accounts. So there should be effectively a balance sheet, profit and loss account, changes in net assets or equity. Presumably you're going to call that thing your surplus deficit accounts, the equivalent of your the equivalent of your capital section. Then you've got your cash flows, and then notice this one here as well, which you don't get in commercial organisations: the comparison of budget and actual amounts for the current year as a separate additional financial statement. So it's taking into account the fact that budgets are so much more important for governments than they are for general commercial organisations. And then the related notes and the disclosures of narrative information about material adjustments as required by paragraph 142. Right, you should go away and have a look at that. But paragraph 142 talks about those items which are major material adjustments that we've had to make. Okay, so we just touched on this at the end of the last slide, but I was a little bit concerned that maybe you didn't get the sort of full picture. This is what's required by paragraphs 141, 142, which are almost at the end of the body. So let's just have a look at these therefore. So it says paragraph 141 is first time adopter shall disclose, so you have to write a disclosure note with explanations. So the information and explanation about how the transition from the previous basis of accounting to Ipsas has affected its reported its financial position and where appropriate. Give some examples and some more information. And then you have to give actual reconciliations. So reconciliations of net assets, equity, etc. Under the old basis to the new basis, and a reconciliation of the surplus or deficit under the previous basis and the new basis. Basically, if you remember earlier, therefore, assuming that you're still with me at this point, we talked about this idea of the Ipsas adjustments account. So basically, what will do it for you is if you just give a list of all of the entries, all of the material entries which have gone through that Ipsas adjustment account. I mean, it's going to be a huge number of transactions there, but that's what you're looking for, and that will give you the reconciliation between the old position and the new position. And obviously, as you've made all of those entries, you can just take the journals and cut them back down. So that's fairly straightforward. Right. There you go. That is standard number 33. It is going to be monstrously important in real life. Right, assuming you've made it all the way this far, thank you very much for sticking with me. We have only skimmed the surface of the kind of stuff that you're going to come across doing implementation. I hope that it was relatively interesting, and the purpose of it was not just to read chunks of the standard to you, but to explain to you how they're actually going to impact on your implementation process. If you have any questions or need anything done for you, you know where we are. Please contact us. We try and do as much as we can free. Other than that, best of luck, and please like us on Facebook, watch us on YouTube, and all the stuff that everyone else does. Thanks very much, guys. Good luck.